Picture this. You're scrolling through investment advice online, and every expert is telling you something different. Buy growth stocks. No, value stocks. What about small caps? International, crypto? Your head is spinning. And meanwhile, your money is sitting in a savings account earning practically nothing. But what if I told you that billionaire investors have been using a dead simple 4-fund secret that beats 85% of professional money managers? What if you could stop the endless research, the constant second-guessing, and the fear of picking the wrong investment? In this video, I'll show you and Eric exactly which 4 ETFs can replace your entire complicated investment strategy. I'll break down the specific percentages you need for your age, show you the shocking performance numbers that will make you question why anyone uses complex strategies, and most importantly, I'll give you the exact step-by-step process to set this up today. By the end of this video, you and Eric will have everything you need to build serious wealth with just 4 simple decisions. No more analysis paralysis, no more sleepless nights wondering if you're doing it right. Before I reveal these 4 magic ETFs, let's talk about the biggest mistake almost everyone makes. You've probably fallen into this trap too. I know I have. The financial industry wants you to believe investing is rocket science. They sell you on the idea that you need dozens of funds, complex rebalancing strategies, and constant monitoring to succeed. But here's what they don't want you to know. The most successful investors in history keep things remarkably simple. Warren Buffett has repeatedly said that a simple index fund strategy will beat most professional money managers over time. Jack Bogle, the founder of Vanguard, built his entire fortune on this idea. These aren't just theories. These are proven strategies from people who've made billions. When you overcomplicate your investments, 3 deadly things happen. First, you start paying higher fees that eat into your returns. Second, you begin making emotional decisions based on short-term market noise. Third, you spend so much time researching and adjusting that you never actually let compound growth work its magic. Think about it. If you own 20 different funds, you're constantly worried about which ones are underperforming. But when you own just 4 carefully chosen ETFs, you can focus on the only thing that really matters, consistently investing over time. Later in this video, I'll show you the exact performance numbers that prove this simple approach beats complex strategies 85% of the time. Now let's reveal the 4 funds that can replace your entire investment strategy. I've ranked these in order of importance, and each one serves a specific purpose in building your wealth. First up is VTI, the Vanguard Total Stock Market ETF. This single fund gives you ownership in over 4,000 American companies, from tech giants like Apple and Microsoft, down to small growing businesses you've never heard of. Here's what makes VTI absolutely incredible. It charges just 0.03% annually in expenses. Over the past 10 years, VTI has delivered 14.5% average annual returns. Just last year alone, it returned a massive 37.85%. Since its launch in 2001, it's averaged 8.8% annually. And here's the cherry on top. It pays a 1.3% dividend yield, sending you quarterly cash payments just for owning it. With $1.8 trillion in assets under management, VTI is one of the most trusted funds on the planet. Second is VXUS, Vanguard's Total International Stock Index. This covers everything VTI doesn't. Companies from developed countries like Germany and Japan, plus emerging markets like China and India. With over 8,000 international stocks, you now own pieces of companies across the entire global economy. VXUS charges an incredibly low 0.07% expense ratio. That's just $7 annually for every $10,000 invested. This fund has delivered 12.9% returns over the past year and 10.4% average annual returns over the past 5 years. VXUS pays a generous 2.9% dividend yield, more than double what you get from VTI. The fund tracks the FTSE Global All-Cap ex-US Index and has earned Morningstar's gold rating for its low fees and superior diversification. Third is BND, the Vanguard Total Bond Market ETF. While stocks provide growth, bonds provide stability and income. This fund holds over 10,000 government and corporate bonds with different maturity dates, giving you steady interest payments while reducing your portfolio's roller coaster rides. BND's expense ratio is rock bottom at approximately 0.03%, virtually free to own. The The fund pays a substantial 3.7% dividend yield monthly. Yes, monthly. While stocks pay quarterly, BND sends you income every single month, making it perfect for retirees or anyone wanting steady cash flow. Over the past 10 years, BND has averaged 1.5% annual returns. But remember, bonds aren't meant for explosive growth. They're your safety net when stocks crash. During market downturns, bonds often gain value as investors seek safety, balancing out your portfolio's ups and downs. Finally, VNQ is the Vanguard Real Estate Investment Trust ETF. This fund invests in companies that own apartment buildings, shopping centers, office complexes, cell towers, and data centers. Real estate often moves differently than stocks and bonds, providing another layer of protection for your wealth. VNQ charges 0.12% in expenses, still incredibly low for the real estate exposure you get. The real attraction here is income. VNQ pays a fat 4.1% dividend yield quarterly. That's because REITs are required by law to distribute at least 90% of their income to shareholders. Over the past 10 years, VNQ has delivered 5.3% average annual returns, and just last year it returned 13.2%. The fund holds positions in real estate giants across every property type, from residential apartments to industrial warehouses that fulfill your Amazon orders. Real estate provides natural inflation protection. When prices rise, so do rents and property values, making VNQ a perfect hedge against rising costs. With only 7% portfolio turnover, this fund is built for long-term wealth building. But here's the key. It's not just about having these 4 funds. It's about knowing exactly how much to put in each one. And that's where most people mess up completely. Having the right funds is only half the battle. The other half is knowing the exact percentages, and I'm about to give you the precise formulas that work for different life stages. If you're in your 20s or 30s with decades until retirement, here's your allocation: 60% in VTI, 30% in VXUS, 5% in BND, and 5% in VNQ. This aggressive approach heavily favors stocks because you have time to ride out market volatility and benefit from long-term growth. Your $10,000 investment would be split as $6,000 in US stocks, $3,000 in international stocks, and $500 each in bonds and real estate. For those in their 40s and early 50s, we shift to a more moderate approach: 50% VTI, 25% VXUS, 20% BND, and 5% VNQ. You're still growth-focused, but adding more stability as retirement approaches. That same $10,000 becomes $5,000 in US stocks, $2,500 in international, $2,000 in bonds, and $500 in real estate. If you're approaching or in retirement, safety becomes more important: 40% VTI, 20% VXUS, 35% BND, and 5% VNQ. The higher bond allocation provides steady income and reduces volatility when you need your money most. The beautiful thing about these allocations is their simplicity. Once a year, you check if your percentages have drifted, and if needed, you rebalance by buying more of whatever has underperformed. But wait until you see the performance numbers I'm about to show you. They'll shock you. Let's look at how this simple strategy actually performs, because these numbers might be hard to believe at first. Here's a real-world example that will change how you think about money forever. Let's say you're 25 years old and you invest just $500 per month using the aggressive allocation. That's less than what most people spend on car payments. Here's exactly how your money grows. After year 10, you've invested $60,000, but your account shows $85,000. After year 20, you've invested $120,000, but your account shows $245,000. After year 30, you've invested $180,000, but your account shows $681,000. That's over $500,000 in pure growth just from consistently investing in these 4 simple funds. But it gets even better. Those fancy funds charging 1 to 2% in fees, with teams of analysts and billion-dollar research budgets. Most of them can't beat this basic 4-fund approach that costs you less than $50 annually in total expenses on a $50,000 portfolio. Let me give you an even more mind-blowing example. The average American pays $550 per month for their car payment. If instead of upgrading cars every few years, you drove your current car longer and invested that $550 monthly, you'd have $747,000 after 30 years. In just a moment, I'll show you exactly why this beats complex strategies. But first, let me address the biggest objection I always get. You might be wondering why this simple approach works better than strategies with 15 or 20 different funds. The answer comes down to 3 critical factors that most investors completely ignore. Reason 1, the fee killer. These 4 ETFs have incredibly low expense ratios, meaning more of your money compounds over time. When you own multiple funds with higher fees, those costs destroy your wealth. A difference of just 1% in annual fees might not sound like much, but over 30 years, it can cost you over $100,000 in lost returns. Reason 2, the emotion eliminator. With a complex portfolio, you're constantly second-guessing yourself. Should you switch your small cap fund? Is your emerging markets allocation too high? These questions lead to constant tinkering, and every change you make typically hurts your long-term returns. With just 4 funds, you eliminate this decision fatigue completely. You know, VTI covers the entire US market, so you don't worry about sector rotation. You know, VXUS gives you international exposure, so you don't stress about which countries to pick. Reason 3, the time freedom. Complex strategies require hours of monthly research and monitoring. This simple approach frees up all that time while actually delivering better results. Think of it like cooking. You could spend hours creating an elaborate meal with 20 ingredients, or make a simple dish with 4 high-quality ingredients that tastes just as good. The simple approach saves time, reduces stress, and often produces better results. But knowing the strategy is one thing. Implementing it correctly is another. Let me show you exactly how to set this up today. Step 1. Choose your broker. Since 3 of our 4 ETFs are from Vanguard, opening an account there makes sense and often means 0 transaction fees. But Fidelity, Schwab, or even Robinhood work perfectly fine too. All major brokers now offer commission-free ETF trading. Step 2. Set up automatic investing. This is crucial because it removes emotion and ensures consistent investing. Most brokers let you schedule automatic purchases weekly or monthly. Step 3. Enter your exact amounts. Let's say you want to invest $1,000 monthly using the aggressive allocation. You'd set up automatic investments of $600 into VTI, $300 into VXUS, $50 into BND, $50 into VNQ. The system handles everything automatically, buying shares based on current prices. Step 4. Optimize for taxes. Consider doing this in a tax-advantaged account first. If you have a 401k, see if they offer similar funds. For additional money, a Roth IRA is perfect since your gains will be tax-free in retirement. Finally, now you know the 4 ETFs that can replace your entire investment strategy. But if you want to add one more powerful wealth-building tool to your arsenal, click the video on your screen right now.